Silver, $60 plus. Peace deal collapsed overnight. The most dangerous weekend setup of 2026? Something happened overnight that almost no one in mainstream financial media is talking about. A peace deal that was supposed to be the silver bullet, pun intended, for the entire precious metals complex just collapsed. And silver, which has already lost nearly 54% from its all-time high set just 5 months ago, is now sitting at a level so critical that what happens in the next 72 hours could define the entire second half of 2026 for precious metals investors. This is the strategic line, and today I need to walk you through the most dangerous weekend setup in the silver market this year, because I think most investors are reading this completely backwards. Here is what we are going to cover today. Why this correction is happening, and why the reason almost everyone is giving you is incomplete. Why the peace deal collapse is not the disaster it sounds like, and may actually set silver up for something nobody expects. The 6-year supply deficit that is quietly compounding underneath all of this noise. And the one number you need to watch this week, not the silver price itself, that will tell you everything about where this market is actually headed. Stay with me, because by the end of this video, you are going to understand the silver market at a level that puts you ahead of 99% of the people who invest in it. Most people look at a chart dropping 54% and run. Smart money looks at a chart dropping 54% and asks, what changed fundamentally? And as I am going to show you today, almost nothing changed fundamentally. Act 1. The crash in context. Let us start with where silver actually stands right now, because the numbers are staggering. On January 29th of this year, silver hit an all-time nominal high of $121.62 per ounce. That was the culmination of a 147% run that began in late 2024 and carried through all of 2025. Silver went from being an ignored, misunderstood metal trading near $29 an ounce to shattering every record in modern market history. And then it stopped. By late June 2026, silver had collapsed to roughly $55 to $59 per ounce. This week alone, it lost nearly 12% in just 2 trading sessions. It is sitting at a 7-month low. It has given back more than half of everything it gained. And the financial media's narrative? Simple. Silver is done. The rally is over. The bubble has burst. But here is what that narrative is missing. Bubbles are driven by speculation, disconnecting from fundamentals. And what I'm going to show you today is that the fundamentals underneath silver have not just held, they have actually gotten stronger during this correction. So if the fundamentals are stronger and the price is lower, what does that tell you? It tells you that something else is driving this price down, something temporary, something that has nothing to do with whether silver is actually scarce or in demand. And that gap between price and reality is where the real story lives. Act 2. 3 forces that broke silver. To understand why silver crashed, you need to understand the 3 macro forces that hit it simultaneously. All 3 converged within weeks of each other, and all 3 are still in play right now. Force number 1. The Federal Reserve went hawkish. 6 months ago, markets were pricing in multiple Federal Reserve rate cuts throughout 2026. The narrative was clear. Inflation was coming down. The economy was softening. The Fed under new Chairman Kevin Warsh would ease financial conditions. Then May CPI came in at 4.2% year over year, the highest reading since April 2023. Non-farm payrolls printed at 172,000, more than double what markets expected. And suddenly, the Federal Reserve's June dot plot shifted. 9 of 18 officials began projecting at least 1 additional rate hike before year-end. Bank of America subsequently forecast 3 consecutive hikes: September, October, and December. That would push the federal funds rate to a target range of 4.25 to 4.50%. What does that do to silver? Silver pays no yield, 0. So when US Treasuries offer you a real return of 2.2% and rising, the opportunity cost of holding silver becomes enormous. Money rotates out of metals and into income-generating assets. The US dollar index surged to near 101.80, its highest in over a year. And a stronger dollar makes silver more expensive for every buyer outside the United States. Silver did not fall because silver became less valuable. Silver fell because the cost of holding it went up. That is a monetary problem, not a fundamental problem. Those are completely different things. Force number 2, the US-Iran peace deal. In February of this year, the United States entered a military conflict with Iran. Oil spiked above $100 per barrel. Inflation expectations reignited, and a war premium got baked into every hard asset on the planet: gold, silver, oil, everything. Then in June, a ceasefire was announced. Then a tentative memorandum of understanding was reached. Then talks extended. And then last week, the deal that was supposed to formalize and end hostilities collapsed overnight. Now, I want you to think carefully about what just happened. Markets had already priced in significant peace optimism. A lot of that war premium was already unwinding. Silver had already fallen 12% in a week, partly because traders were selling the anticipated peace. And now the peace deal is not happening. That means the inflation risk from this conflict is back on the table. That means the pressure on the Fed to hike may actually ease. Because if oil goes back above $100, that changes the macroeconomic calculus in ways the rate hike camp has not fully modeled yet. The peace deal collapsing is not obviously bearish for silver. Think about it. More war means more oil risk. More oil risk means more inflation. More inflation means more pressure on the Fed, but it also means more demand for hard assets as inflation hedges. I am not saying this is bullish. I am saying the mainstream media is giving you a simple narrative for a deeply complicated situation. Force number 3, forced selling and cross-market contagion. This is the force almost no one is talking about. A significant portion of silver's decline this week had nothing to do with silver. US tech stocks had a bad week. The crypto market has lost over half its value since late 2025. When investors are getting margin calls in one part of their portfolio, they sell whatever they can to raise cash, including silver. Liquid, tradable assets get dumped, regardless of their underlying value. Silver fell 12% in 2 days, not because silver became less scarce. It fell because investors were selling silver to cover losses elsewhere. That is not a fundamental breakdown. That is a liquidity event. Act 3. The deficit that does not care about the price. Now I want to talk about the story running quietly underneath all of this volatility. Because while traders are panic selling silver on futures exchanges, something completely different is happening in the physical market. The Silver Institute's World Silver Survey for 2026, compiled with Metals Focus and released this April, confirmed a 6th consecutive annual supply deficit. Not 5 years, 6. 6 years in a row where the world consumed more silver than it produced. The 2026 deficit stands at 46.3 million ounces, and since 2021, cumulative draws from above-ground silver stocks have reached 762 million ounces. That is roughly 9 months of total global mine production just gone, consumed, not coming back. Now here is the part that I want you to sit with for a moment. Mine supply cannot simply respond to demand. Approximately 70% of all silver ever produced comes out of the ground as a byproduct of zinc, lead, and copper mining. Miners do not ramp up silver production because silver prices rise. They mine whatever primary metal they are chasing, and silver comes along for the ride. Total global silver supply is expected to grow just 1% in 2026 to approximately 820 million ounces, while industrial demand continues growing at 3 to 5% annually. The arithmetic is not ambiguous. It points in one direction. And the demand side of this equation is not slowing down. It is accelerating. Solar photovoltaic manufacturing uses silver in its conductive paste, and it cannot simply be replaced. Electric vehicles use silver in battery management systems and charging infrastructure. AI data centers use silver in their hardware components. Defense systems use silver for its conductivity and reliability. These are not cyclical demand sources. They are structural. They compound annually. In Shanghai, physical silver is still commanding a premium of roughly 10% or higher over the Western benchmark price. That premium is telling you something the futures market is not. In the East, where the physical metal is being consumed for industrial purposes, buyers are paying above the spot price to get real silver in their hands. COMEX registered inventories have rebuilt from their earlier lows to roughly 87 million ounces. But that recovery came almost entirely from owners reclassifying existing metal ahead of the July delivery cycle, not from new bars arriving at the vault. The squeeze narrative in the West may have temporarily eased. The shortage narrative has not. The paper market and the physical market are telling you two different stories right now, and eventually, one of them has to be wrong. Act 4. The $60 line and what happens next. Silver is hovering near $59 as we record this. The $60 level is now critical, and not just technically. It is psychologically critical, analytically critical, and structurally critical all at the same time. Here is what the technicals are saying. The relative strength index on the 4-hour chart is approaching 20. That is a level that has historically signaled the exhaustion of a selling move, not the beginning of a new one. Silver is testing its December 2025 low of around $56.45. If it holds there, that is the most meaningful support test of this entire correction. If it breaks through, the next level that matters is somewhere in the mid-$54 range, and below that, the November 2025 low near $48. Now let me give you the bull case and the bear case straight. No bias, no spin. The bull case requires two things to come together. First, Fed Chair Kevin Warsh signals that the inflation picture is more nuanced than the headline 4.2% CPI suggests. And here is something interesting. Warsh has publicly indicated a preference for using trimmed core PCE as his inflation benchmark, which currently reads around 2.3%, close to the Fed's 2% target. If Warsh frames May's hot CPI print as geopolitical inflation driven by the Iran war, rather than structural inflation driven by wage growth, the rate hike math changes completely. Second, the peace deal collapse keeps oil at elevated levels, removing the key disinflationary force that was justifying the hawkish FOMC shift in the first place. If both of those conditions materialize, the path towards $72 to $74 opens up relatively quickly. If the physical deficit continues to draw down above ground stocks, and if COMEX delivery stress resurfaces, which the July delivery cycle is about to test, the longer-term path to $90 and above remains analytically intact. The bear case is actually the simpler case right now. If the dollar stays strong, if Warsh confirms additional rate hikes, and if the peace deal eventually gets signed, removing both inflation fear and the geopolitical premium, silver retests $60 to $63 on the downside. And that would not be a catastrophe. That would just be more of the same correction we have already been living through. But here is what I find most interesting about the bear case. It requires the ceasefire to hold and the Fed to hike simultaneously. Those two things pull in opposite directions. A sustained peace would bring oil down, ease inflation, reduce the justification for hikes, and, over time, bring the Fed back toward neutrality. In that scenario, the structural deficit begins to matter more and more. Act 5. COMEX, paper versus physical, and the mechanism most people miss. I want to take a moment here to explain something that most retail investors never fully understand, and it is the key to why silver's price can fall 54% while the physical market simultaneously shows a sixth consecutive annual deficit. COMEX, the New York Futures Exchange where silver is traded, does not primarily deal in real silver. It deals in paper contracts. One contract represents 5,000 ounces, and the number of these contracts traded daily is orders of magnitude larger than the amount of physical silver that actually changes hands. This means that in the short term, investor sentiment expressed through paper positions drives the price. Not physical scarcity, not industrial demand, not the 6-year deficit. Paper positions. When tech stocks fall and investors need cash, they sell silver paper. When the Fed goes hawkish and investors rotate to yield, they sell silver paper. When a peace deal gets announced and the war premium deflates, they sell silver paper. None of these actions reflect what is happening in the actual physical silver market. They reflect portfolio management decisions made by traders who may have never owned a single physical ounce of silver in their lives. This is the fundamental disconnect in the silver market, and it is also the fundamental opportunity. Because here is what history shows us. Paper market dislocations from physical reality do not last forever. Eventually, delivery cycles force a reckoning. Eventually, the metal that is being consumed by solar factories and EV manufacturers and AI data centers has to be sourced from somewhere. And when the paper price and the physical reality diverge far enough, the paper price moves toward reality, not the other way around. The ratio of paper silver traded on COMEX to physical silver actually available for delivery has historically been one of the most reliable leading indicators of future price pressure. At certain points earlier in 2026, that ratio reached 28 to 1. It has since normalized to around 6 to 1, which tells you the acute squeeze has resolved. But the structural deficit that made the squeeze possible in the first place, that has not resolved. It has grown. 762 million ounces of above-ground silver drawn down in 6 years. The squeeze left, the shortage did not. Act 6. What the gold-silver ratio is telling you. Let me give you one more data point that I think is critically underappreciated in this moment. The gold-silver ratio right now stands near 68 to 1. That means it currently takes approximately 68 ounces of silver to buy a single ounce of gold. Now let me put that in historical context for you. In April of 2025, this ratio hit 105 to 1, a historically extreme level that has only been seen during severe financial crises and periods of silver deep undervaluation. That reading was a signal, and the investors who understood what that signal meant made 147% over the following 9 months. By January of this year, the ratio had compressed to approximately 50 to 1, as silver dramatically outperformed gold at the all-time high. A ratio of 50 represents a 14-year low. Today we are back to 68. The correction has unwound the entire outperformance. Silver is back to a ratio that is roughly in line with its 50-year historical average of 65 to 70 to 1. Here is what that means practically. Silver is no longer the screaming bargain relative to gold that it was at 105 to 1, but it is also nowhere near the frothy overvaluation territory that historically precedes prolonged bear markets. A ratio of 68 says neutral to slightly undervalued. Historically, ratios in the 60 to 70 range have marked the transition zone where silver accumulation begins to outperform. If the macro backdrop shifts, if the Fed pivots even slightly, if real yields compress, if the dollar weakens, history suggests silver begins its next outperformance phase from a ratio in this zone. And if you think about where JP Morgan has set their year-end gold target, $6,300 per ounce, and Deutsche Bank at $6,000, and you apply even a conservative ratio of 60 to 1 to those gold targets, the math for silver starts to look very different from what the current chart would suggest. I am not making a price prediction, but I am showing you the framework. And within that framework, the risk-reward calculation has shifted significantly over the last 5 months. Act 7, the week ahead, the binary moment. Here's where we are right now as of this weekend. The US-Iran peace deal has collapsed, or at minimum stalled in a way that reintroduces significant geopolitical uncertainty. Oil markets will open Monday trying to price that uncertainty. If oil moves back toward $90 or higher, inflation expectations reaccelerate, the Fed's rate hike path gets more complicated, and the dollar potentially weakens from its one-year highs. Watch crude oil specifically. A sustained move back above $85 per barrel would materially shift the inflation arithmetic, and with it, the case for additional Fed tightening. That single number, oil, may tell you more about silver's next move than silver itself. The second thing to watch this week is physical delivery data. The July COMEX delivery cycle is beginning. After the recent reclassification of registered inventory, where existing metal was simply moved from eligible to registered status, with no new bars arriving, the actual delivery demand in July will be a real test of whether physical tightness is returning or whether the market has genuinely rebuilt its supply buffer. Watch LBMA Silver Vault reports. Watch COMEX registered inventory levels. Watch for any spike in silver lease rates, which would signal that borrowing physical silver is becoming expensive, a leading indicator of delivery stress. And watch the PCE data that is now in the market. Core PCE, running at 3.4% or higher, validates the hawkish Fed. Core PCE at 3.3% or below opens the door to a different narrative. This is the binary that paper traders are positioned around, and that positioning, heavy on the bearish side right now, creates the setup for a sharp reversal if the data surprises. Markets right now are positioned for more pain. That positioning itself is an input into what comes next. Let me leave you with this. Silver hit $121 in January. It is trading near $59 today. The mainstream narrative says the rally is over. The smart money is rotating to yield. The metal had its moment and now it is done. But here is the alternative read. 6 consecutive years of supply deficits, 762 million ounces of above-ground stock consumed, a 6-year low in COMEX inventory relative to delivery obligations that was only recently masked by reclassification. not by new supply. Physical premiums in Shanghai running 10% above the Western spot price. Industrial demand from solar, AI, EVs, and defense that is structural, not cyclical. And a paper market that has driven price 54% below its peak, not because silver became less scarce, but because institutional investors needed to raise cash, and the cost of holding yield-free assets went up in a high-rate environment. If those conditions were driving a stock lower, a company with growing revenues, a structural competitive advantage, and a tightening supply of its product, we would call it a buying opportunity. We would talk about the disconnect between price and value. With silver, most people just call it a crash and walk away. The question I want to leave you with tonight is a simple one. If 6 years of deficits could not break the physical silver market while prices were at $121, what happens to price when those same deficits are still compounding? The paper market is exhausted on the short side, and the Fed eventually tell whether in late 2026 or in 2027 begins to ease. That is not a question with a guaranteed answer. Nothing in markets is guaranteed. If it were, it would not be a market. But it is a question that every serious investor in this space needs to have a considered, data-based answer to, because the next move in silver, whenever it comes, will not wait for everyone to feel comfortable. It never does. If this kind of analysis is useful to you, the kind that goes beneath the price chart and actually asks what is driving the market, make sure you are subscribed and consider leaving this video a thumbs up. It genuinely helps more people find content like this. This is The Strategic Line. I will see you in the next one.